Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This show is brought to you by C5 CCIM Global Summit. You want to check this out. It's September 28th to September 30th. I'll give you the website so you can learn more. It is c5globalsummit.realestate. Is it c5globalsummit.realestate? So check it out. Well, today we have a great show for you. We're going to talk about the U.S. Deals 2023 mid-year outlook from PwC. And PwC does a great job of looking at the market, what's going on, what's moving ahead, where are we, where are we going. Please welcome my guest. It's Tim Bodner. He's Global Real Estate Deals Leader for PwC. Tim, good to see you.
Good to see you again, Michael, and do this in person, which makes it a lot more fun.
Awesome. Yeah. Welcome to Studio One here in Atlanta.
Yeah.
Thank you for coming.
Of course.
And I guess the first thing I want to ask you, what you're seeing out there and what you're expecting moving forward is just transaction volume, right? So we're brokers here throughout the Southeast, and we're seeing transaction volume down from our desk, but we're starting to see pick up a little bit. What's really going on?
Yeah. I mean, so I think number one, the point that needs to be acknowledged is transaction volume is down. It's in particular down significantly from 2021, right? Which was a year that was, when you look at it by all measures, an anomalous year. So we need to acknowledge that it's down. The second point we need to acknowledge is that it's much more challenging to get deals done in this environment than it has been. There's financing issues. We're still dealing with inflation. We're dealing with a shifting monetary policy. We still have geopolitical implications. So it's a challenging environment. Having said all that, not only here in the U.S. and around the world, we still are seeing deals get done in sectors where there's strong trends behind them. And we can certainly talk about what some of those are. So for those market participants that are creative, patient, and willing to take the long view, that's who we're seeing be active in this environment. Yeah,
that's a good point. We're seeing a lot of investors that on the sidelines, but then we're also seeing a lot of investors that are taking advantage of the lack of competition, the lack of buyer competition, and that there's more properties that it's like I've had some land buyers that tell me yesterday, said, well, you know what, we couldn't buy any land for the last several years because the apartment developers would outbid us, but now we can buy land again.
It's incredible. And I think on that particular point that you mentioned around buyers who previously were priced out, two interesting points I think for folks to kind of consider is, number one, we're seeing family offices and high net worth individuals around the world being increasingly focused on opportunities within U.S. real estate. And that I think is attributable in large part to what you just hit on, which is that they feel like they're in a position of strength in this environment, whereas before they were competing against much deeper pools of capital. Mm-hmm. The second thing that I think we should acknowledge is that the sovereign wealth funds, in particular from Asia and the Middle East, are aggressively looking at their deployment of capital into U.S. real estate. And we've seen a number of examples of deals getting done by those market participants here, but that is attributable to the environment. And so it'll be interesting to see when that balance shifts back to more of the traditional buyers that we saw in prior cycles. Yeah.
Well, it's a good time, I think, for investors to be looking at the U.S. I mean, if you look at real estate as usually a long-term hold, right? Yeah. So if you're getting at a lower basis, you're getting better pricing, right? On a long-term hold, it makes sense. I know a lot of the properties I've owned a long time. And if it maybe, it almost doesn't matter what I pay for them, when you own them long enough.
That's right. And we're seeing that. I mean, I was just on a conversation with a large sovereign wealth fund yesterday morning talking about a large manufactured housing portfolio. And we were talking about the exit cap rate. And the minute the conversation shifted to listen, this is a long-term hold. These are high-quality assets that are in markets that would take years to kind of replicate that portfolio. The conversation around the exit cap rate completely came off the table, and it all became about what's the cash flow, the near-term cash flow, and what's going to be the way to drive value creation, which is something that we're seeing a lot of attention on in this environment, which is, okay, we have the portfolio. How do we actually double down on how we create value inside of the assets? And so to your point, where you can hold it long enough, which a lot of these investor pools that we were just talking about, family offices, high net worth individuals, sovereign wealth funds, that's where the conversation shifts pretty quickly.
Yeah, good point. So we're talking with Tim Bodner about their U.S. Deals 2023 mid-year outlook. And of course, one of the things that impacts commercial real estate is the financing market of banks. So, as you look here mid-year, what do you see there?
The financing markets are still incredibly challenging. When you look at it, the CMBS market is yet to kind of come back to where it needs to be. The banks have certainly pulled back on their lending from where they were. There's still stress in the regional banking system, and we have the overhang of what the regulators are going to do around capital requirements. And so when you put all those factors together, the financing markets overall are still challenging. Having said that, there still are financings getting done. We were talking before we came on about the effect of lower loan to value ratios, different coverage levels, different terms. So there still are financings getting done, and so that's a good thing. The other interesting thing that I think will be interesting to see what happens is the amount of capital that's going into private credit is at an all-time high, and some have referred to this as the golden age of opportunity in private credit. You've even had some people say that the best investment in this market is investing in office debt, right? Which is kind of quite interesting. I think it's a little bit unclear at this stage to what degree the private credit market can absorb the pullback in the traditional real estate financing markets, but certainly we continue to see around, not just here in the U.S., but around the world, a lot of focus on private credit. The last point I think I'll mention on this is to what extent the activities of the insurance companies that are sponsored by some of the large alternative asset managers, to what extent do they try to step in and kind of create some type of liquidity with the regional banks in order to kind of jumpstart the engine that we all know is so important to the functioning commercial real estate markets, which is a healthy regional banking system.
Yeah, that's true. Tim, what do you think about the governmental impact, what's going on with government spending on commercial real estate?
Yeah, so I think there's a couple ways to come at this. Certainly when you look at the real estate that the government directly owns, office buildings, particularly where I live in Washington, D.C., it's an area where the government is certainly still trying to get people to come back into those buildings. And so it's still, if you look at that pool of assets, I think it's a little bit unclear in markets like D.C. How that gets done. I think the other interesting way to look at this is the real estate impact of some of the policies that this administration has implemented. In particular, things like the Inflation Reduction Act, the Infrastructure Bill, the CHIPS Act. I think when you look at places like here in Atlanta, places like Phoenix, Arizona as an example, Texas, the amount of money that they're kind of influencing being put into creation of manufacturing facilities, whether it be battery manufacturing facilities, semiconductor manufacturing facilities, other things associated with ESG related topics, there's a significant amount of volume, and in some respects it might be the next attractive investment opportunity. Yeah,
good point. And let's talk about some of the sectors. Sure. And what you're seeing, and let's talk about some of the more niche sectors, but let's start with some of the big ones. Industrial real estate. Yeah. What's your mid-year outlook there?
Well, listen, industrial continues to see, incredibly low vacancy, and it's still, by all measures, I think, the place where people have the most conviction. What's interesting, I think, is some people are starting to question is how much can industrial valuations increase before it kind of reach capacity. In fact, one of the large alternative sponsors was on one of the I think it was the CNBC a week or so ago, and he got asked that question, and I think it's unclear.
Yeah.
But having said all that, it's undeniable that there continues to be more commerce going online, and that is a good thing for industrial. And so we're still optimistic about it. But I do think that it is a little bit time to be a little bit more cautious than where it was before, because some of the opportunities around valuation increases, mark to market on rents, it's different than it was in some cases.
Yeah. Let's talk about retail.
Yeah.
What do you see there?
Yeah, retail is funny because, when I think the last, 5-10 years, everyone was talking about how retail was not going to exist anymore. And now when you look at it today, certainly there's been a lot of retail that has been repurposed. But in many respects, real estate's actually doing quite well right now, right? When you look at grocery anchored retail, when you look at retail that's attached to mixed use developments, experiences, it's where a lot of capital is going, which is incredible when you consider some of the negativity around it over the last number of years.
Yeah. I live here in Atlanta, and it's the retail in Atlanta is just super busy. It's like every market I go to, they're just packed.
Yeah.
Like people spending money.
Well, and I think, it's what's interesting is that the other thing that we're seeing happen in retail is the tenant base is shifting. Mm-hmm. And so in a number of the large malls, for example, we're seeing a lot of the large owners being aggressive around competitive socialization. And so if you think about concepts like Topgolf in different sports, you think about sports like soccer, or you think about baseball or basketball, a lot of the tenants, their space requirements are quite large. So they're aggressively looking at bringing some of those tenants into their centers or facilities in order to kind of create.
And pickleball.
Yeah, I mean, where do you stop on pickleball? You can't talk to anyone these days without them talking about their last pickleball game.
Right.
So it's another great example. And the tendency of the retail centers is changing. But what's interesting is if you look internationally in places like Singapore or the Middle East, the retail center is actually, that's where people go for an experience, right? They drop. I was in Singapore a couple weeks ago, and I was talking to one of the large investors down there, and they were saying that culturally what happens there is they go there on the weekends, they drop their kids off at enrichment centers, and then they go and they spend their whole day in the mall, and they go back and pick them up at the end of the day. I think what will be interesting to see is how much does the U.S. learn from that, and does that become more commonplace here, which is, I mean, if you remember when I was little, like that's what we went to the mall all the time.
Right.
Does that change more, and is that more what we do here, just to be around other people and do things? So it's certainly an interesting space to watch. Yeah,
it is, and I think it will continue to be happen and be more experience involved. So let's talk about multifamily. It certainly has had a great ride, and it seems like we still need more housing.
Yeah. Well, look, when you look around the U.S., the multifamily market is in a different place than it was, historically. We talked on the last time we were here about how much longer can rents run, and I think we're at a point now where that's certainly being inflected. However, there's still an acute shortage of housing in this country, and so we see multifamily development still happening around the country, and even in DC, which might surprise some people. There's a lot going on. So it's still a sector that we feel we're optimistic about, and think that capital will focus on. But it's time to be a little bit more cautious. Mm-hmm. What's also interesting about, if you look kind of back up and look at residential more broadly, we do see a lot of attention on affordable housing, and there's a number of different ways that people are expressing that. One is manufactured housing, where we are seeing a number of large deals in the pipeline that people are trying to get done in the manufactured housing sector, particularly in the Southeast, and also the creation of affordable housing strategies that may not be connected to certain federal programs, but that are done at a price point that is more affordable. And when you talk to the sponsors behind those, the CEOs, the capital providers, their motivation for that is very much a social motivation. It's about a realization that we do have a real problem that we need to fix. So when you look at it holistically, encompassing of all of residential, it's still an opportunity. It's still an area where we see a lot of people focusing their capital on.
How about student housing?
Yeah, I mean, listen, what's fascinating about student housing is we don't have any public student housing companies any longer. They've all been taken private, and so the cost of capital is much different than it was historically. And so what we're seeing in the student housing space is a number of universities looking at programs like the 501c3 structure and how can they leverage the favorable financing market to create new student housing developments. But it's a reality. We don't have enough student housing in this country or candidly around the world. And there's been plenty of examples of places like California where students are sleeping in their cars because they don't have enough housing in California. And there's been a number of people and people like Charlie Munger and the like who have been very vocal about how do we create more student housing capacity in the state of California system. So it's an area where we're seeing a lot of activity for sure, but the way it gets financed is much different than it was historically, for sure.
We're as brokers, we're still seeing really low cap rates on student housing and on multifamily. Certainly lower than the interest rates they're having to pay if they're financing them. So negative leverage. Yeah. What about senior housing? It seems like senior took a real hit in COVID, and transaction volume dropped significantly. As brokers, our senior housing division is getting quite busy again. What do you see overall when you look at the market?
Yeah, I think when you look at healthcare real estate overall, it's still an area where there's pockets of capital that see opportunity there. What I would say is that there is to some degree in certain pockets of the senior housing real estate ecosystem, there is still concern around the regulatory impact of certain government programs and what happens with reimbursements and the like. So I would say there's caution. But on balance, when you look at it holistically, it's an area where certain pools of capital still see opportunity broadly.
Yeah, we certainly see that, and I think senior housing is not into its prime years yet, right? Until the baby boomers get up in age. Yeah,
that's a big. Yeah. There's a large shift in the demographics of this country for sure. I think what would be interesting to see is what does the senior housing of the future look like, and how much of it's part of other kind of like mixed use developments, for example, for the reason that people are aging, but they still want to be part of an experience that enables them to do things that they otherwise couldn't do, or just get to certain places easier than they otherwise would have, like the grocery store and the like. So it's certainly an interesting space to watch.
Yeah, and knock on wood, I'm not the senior housing age yet, but I have a home on a lake here in the north of Atlanta, and I keep a place in town that isn't a mixed-use development, and it's really nice just to walk out and have everything. It's just like a great lifestyle.
That's right. Yeah.
I can imagine. What age would you want to not have that? I mean, that's just fantastic.
It is, and what's incredible is how much of that is still real estate development is going on in that respect across the country. If it just we were talking a little bit before about, like, for example, the wharf in DC or even National Landing, which is where the second Amazon headquarters just went in, and the amount of energy around mixed-use development and people wanting to be part of that is at a level that hasn't been seen before. In fact, if you go down to the wharf on a weekend, good luck finding a parking spot after 5. Yeah, I mean, it's everywhere. That's where people want to be. So it's interesting to see.
That's cool. What about the hospitality market, the hotels? It seems like they got really busy after COVID kind of ended, I guess.
Sure. Yeah, I mean, listen, when you look at RevPAR across, both the major gateway cities and even some of the secondary markets, it's still quite strong relative to 2019. It's still above 2019 levels, which is kind of incredible to think about it. However, there is a little bit of kind of like a softening in the RevPAR levels. So I think it's an area where people need to be cautious. We saw this week a number of hotels by one large owner going back to the lenders. So we saw it in certain cities on the West Coast a couple of weeks ago. So it's a place to be cautious. Having said all that, when you look at the amount of capital being put into all-inclusive resorts and experiential resorts by the large brands, extended stay brand, there's still a lot of capital going in, a lot of development. So it's an area where you still see a lot of optimism, but it's one to kind of be careful on, because there are certain pockets of the country that are experiencing stress.
Yeah. Tim, where do you think there's some opportunities out there in some of the various sectors and geographic areas?
Yeah. So I think one thing that we need to kind of continue to focus on is the amount of GDP that is being shifted from the Northeast to the Southeast and the Southwest. When you look at places like Georgia, where we're sitting, you look at the Carolinas, you look at Florida, you look at Texas, you look at markets like Arizona, there is a significant amount of GDP that's being shifted into those markets. And so that's something I think we need to be conscious of in terms of how we allocate capital from a real estate perspective. We talked earlier about the effects of the governmental programs on manufacturing facilities. Like, a lot of that's happening in those states I just mentioned. So what will be interesting to see is the indirect impact on sectors like office, industrial, retail of being in those markets. And do we see more valuation increases, a cap rate compression and the like, and the more stronger rent growth in those markets? Do we see capital moving into markets? So I would say that the Southeast and the Southwest are the markets to watch for sure right now. In terms of opportunities, we continue to see, and we talked to some of the prominent design firms about what they are seeing in their pipeline in terms of activity. Anything kind of around experiential related, there's a lot of conviction still. And there's a number of ways to express that. We talked about mixed use development. We can talk about sports. We can talk about what's happening in Las Vegas with all the new development. We could talk about casinos. We can talk about wellness, real estate. We're seeing a lot of capital focusing on that broader theme and expressing it differently. But the idea that that's where they see kind of some white space where there's not a lot of the risk is lower and there's not a lot of competition. So that's kind of the new-ish space to watch. In terms of the traditional food groups, I think we should watch office, right? I think people are very negative on it, but we are starting to see some people take the contrarian view and go take some positions. And you were talking about a couple of deals that you guys have been working on in the space, and we think that's like a space to watch, just given the amount of negativity around it.
Yeah, I think that's a good point. We're seeing even some of the really high quality, nicer properties sell at a higher cap rate, so you have a lower basis. And then we're seeing a lot of the distressed office. People are getting some real bargains. It'll be interesting to see how much money's made from the contrarian investors there.
That's right. Yeah.
We just got our first foreclosure listing on an office building, and it's medical and lab space. So it's like, all right, so if somebody's got a tenant or a user, it's a big home run.
That's right.
And it's in Atlanta. So it's like, as you mentioned, the medical MOBs and medical office buildings are selling really well.
Yeah.
Our government leased office buildings are selling really well. It's like, well, you figure they're going to pay the rent because they're going to take the money from us.
That's right.
They're going to pay the rent.
Exactly.
Yeah.
That's right.
And they see, we talk to a lot of leaders that are in these buildings, and almost every one of them says we got to get our people back in the office.
Yeah.
Yeah.
It's interesting though. Like certainly it feels like the momentum is shifting. Mm-hmm. So, for example, if there's for months the headline's been that office utilization is lower than it has been, but over the last number of weeks, if you look at the Castle statistics or you look at some of the markets like New York, there's this. It feels like the narrative shifting a little bit to be one more of being optimistic. Well, like maybe like people actually will come back to the major cities, and they're not just going to sit in their house all day.
Yeah.
Yeah.
Yeah, I agree. I think it's going to come back faster and stronger than people realize. I think we're just so used to the behavior we have now of a lot of people's behavior is not to work, you know, or to just work at home and not be as concerned about being productive.
Well, just look at it. If you go back to where we were at the beginning of COVID, when people said that nobody was ever going to go back to a retail shopping center again. And we just spent time talking about that. It's certainly, we shouldn't be naive to say that, you know, go back and say office is going to be exactly what it was before.
Right.
You know, sure, retail is not the same as what it was before, but to say that people aren't going to spend time in an office anymore, I think is a little bit like saying there won't be any retail centers anymore.
Yeah, good point. Well, Tim, what would you leave our audience to think about?
Oh, well, yeah. Well, so we continue to see. I think the number one point would be that number one, where you invest does matter, and that there are opportunities in the market. And the second thing we would say is, this is a time to be creative. And if you go back for years, we were talking about this before we came on. For decades, real estate investors have had to navigate market cycles, and they've found a way to get through it. And this is just another one of those cycles that while there's challenges, there's a lot of opportunity, and we think that people will find a way through, and we'll have some bumps on the way. But on the other side, I think we'll look back and say, we did it again, not just like we did before. Yeah,
well, good point. And I think if you're own properties, your asset manager, and you're thinking it's not the right time to sell, I think one of the things we're finding as brokers on the front lines here is that there's a lack of supply. So we're still getting multiple bids and multiple buyers for most everything that we take out. And I think I'd leave a message for lenders. I think this is a great opportunity to build relationships, do some great loans while you have less competition. You're probably getting a lower loan to value. You're probably getting better underwriting. You probably hopefully you don't have rate risk at maturity. Yeah. Let's hope rates aren't significantly higher when these loans mature.
That's right.
But your point, we're seeing some investors that they kind of are really wringing their, pushing their, what do you call it, wringing your hands together? Yeah. And they're happy. There's less competition, then get into lower bases and do some good deals. Well, Tim, thanks for being here. Great information.
Great to see you.
As usual. Yeah. Good report. Thank you. And thank you for joining us around the country while watching or listening. Thanks for sharing. Please connect with us on your social media. And until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. Appreciate the show? Consider referring business or doing business with our sponsors. Bull Realty is a commercial real estate sales, leasing, and advisory firm doing business throughout the Southeast, headquartered in Atlanta. Visit bullrealty.com for more information. Commercial Agent Success Strategies provides video training for commercial agents. This training gets 5-star reviews from even the most experienced brokers. Learn more at commercialagentsuccess.com. You're invited to connect with us on your favorite social media. You can find us on LinkedIn, Facebook, and Twitter. Don't miss a show of special interest to you. Be sure and subscribe to the show on YouTube and Apple Podcasts. And at the show website, creshow.com, you can subscribe for a weekly email announcing the show topic and guest. While you're there, you also found more videos and podcasts. Thank you for watching or listening to America's Commercial Real Estate Show.